right, you all know I love to watch the commodities, and here we have oil prices this morning on the decline, oil off about 1%. But so far this year, the story has been oil plunging, down about 18% year to date. But a new report from Barron's says higher prices may be coming. Accelerating demand and less supply could push oil to $60 per barrel this year. Joining us this morning is the Schork Report publisher, Stephen Schork. Stephen, could we see, well, of course we could, but will we see $60 a barrel as they're suggesting? Good morning.
Well, it's an excellent phraseology there, Sandra, because we should focus on the auxiliary verb here. I'm in San Diego today, and we could rain here today. It's unlikely, but it could happen. And that's the same with oil. It could hit $60 a barrel, but it's very unlikely at this point.
All right. So, I mean, they're predicting we're going to see a pickup in demand. And, I mean, this is the story, right? Prices get low enough where things start to turn around. But obviously, as a question that I'm supposed to be asking you, because you're supposed to have the answer, Stephen Schork, is when that turnaround may be coming.
Right now, they're at a difficult point. When we speak about demand, we have to keep in mind that demand for oil today has never been stronger. U.S. oil refineries are boiling the most crude oil they ever have in their history, and that has failed to do anything with regard to price. Now, when we look at the OPEC production cuts, we had very strong cohesion in the first quarter, but that cohesion is starting to wane, especially now that Libya, which is not beholden to the quota, is now producing a lot more oil than they were, or they thought they could be just 6 months ago. So when you have a combination of OPEC cohesion probably never going to be as strong as it was in the first quarter, and the combination of record demand, and that has failed to balance the market.
So Steve,
it's hard to make a bullish case in the second half, when demand now starts to approach
So as we
lows.
look at this world map, assume I'm not as inside baseball with oil as I normally am. So bring me up to speed on where we are with exports and where we are with China, because the story had become right that China was peaking in their oil demand. But then, I don't know, the recent reports I've seen, demand is extremely strong still for oil in China.
Absolutely. Now, the demand story in China had a lot to do with these, quote-unquote, these smaller refineries that were not beholden to more of a more laissez-faire from the government of Beijing. But demand has certainly been strong. It's been strong in India as well, in all of the emerging markets. But let's keep in mind, there's the other side of the equation. While we do have demand, the price action and what we've been seeing out on the curve suggests that supply still outstrips demand. To the point, over the past 2 years, during the crash in oil prices, we've seen a strong propensity by oil producers to hedge their forward production 2-3 years out when spot oil prices were in that $47 to $54 range. So right now we're looking at not only U.S. producers but global producers of oil who are extremely well hedged going out into the future. So there is the argument to be made now with oil, spot oil back into the low 40s, that this is going to be an incentive for global production to pull off. But it's not the case at this point, because we've already sold a considerable amount, and I should say at certain points this year, a record amount oil forward. So when you sell a future, that is, when a crude oil producer sells a future contract, they're only doing that because they're planning on bringing back more production to the market.
Yeah.
So yes, demand has been strong.
Let's shift gears to the domestic market.
Sure.
And one of Donald Trump's key economic priorities is energy. And you've seen the New Star pipeline permit approved. That's 108,000 barrels that will transmit between Texas and Mexico, about 2% of supply. You've also seen $29 billion of capital projects put on pause or halted entirely after Keystone XL. So give us some insight into your view of what the infrastructure looks like over the next 3 to 5 years.
Well, right now, that has been the play from an investment standpoint. Now, from an infrastructure standpoint, over the last 8 years with the previous administration, it was clear that capital in this industry was not welcomed and would not be well treated. So with the Trump administration, what we've seen is clearly the message that the U.S. hydrocarbon economy is once again open for business. So we're going to take more of the politics out, for instance, the politics that were played around Keystone XL, which everyone, the EPA, Hillary and John Kerry's State Department, all signed off on it. It was just some hedge fund guy out in California who didn't want it built, and so it wasn't built. Now the projects have changed. There's been a tremendous amount of investment, and let's forget about this idiotic wall forcing Mexico to pay for some wall. Mexico's already investing a tremendous amount in the U.S. economy with regard to investing in pipelines and transport to get U.S. natural gas into that country. So the dynamics have certainly changed, and it is a welcome change.
Steve Forbes, what I'm getting from Stephen Schork is a lot of information, good information, but I'm still left wondering, is supply so strong that prices can't move up regardless of how strong demand is? Or what's your takeaway here? I'm going to bring Steve Forbes in for a second.
Yeah. The only way you're going to get oil anywhere near the levels we saw a few years ago is if the dollar substantially weakens.
Yeah.
If not, it's going to be under pressure. Commodities are under pressure. It's not just oil.
Yeah. Steve Schork?
Yes, so yeah, that is absolutely agreed. And when you talk to OPEC, as I have done, the dollar is a key integral into the direction of price. So to this point, from $60 oil, the problem with that forecast for the end of the year is because demand is now at its strongest. It's only going to pull back from a seasonal perspective. We're going to see in 2 months 1.5 million barrels of demand taken out of the market as the summer demand peaks. When you have that coupled with the fact that we're going to be adding another 100,000
so leave me with the forecast, Stephen Schork.
Domestic.
Labor Day, where's oil price?
Labor Day at oil prices, I'm going to go down with the next technical range, a key area of range, between $41 and $37 a barrel. I'll call that at this point
So it's going
the bottom
nowhere,
of the market.
is what you're saying. Between 41 and 47? All right.
Yeah, I mean, the demand's at its strongest now, and we're not moving any higher, and certainly by Labor Day, the demand, and we'll be looking forward, and the demand's going to be going lower from that point.
All right, Stephen Schork, very good to see you.